Good evening, everyone. Apologies for the slight delay. I hope you're all doing great this evening, and I hope the markets are doing well as well for you all. We have a very interesting week ahead, really interesting week, and I just thought it would be important for us to go through this really interesting topic, which I believe has a lot of relevance to the financial markets. And without wasting time, we can just dive right into it. So I'm seeing Godfrey, Michael, Lemuel, Ambrose, you're all most welcome. Please, I hope you are able to pick something nice and exciting from today's webinar, which we're going to handle on understanding order blocks. So without wasting any more time, I think we can commence. Okay, so order blocks are very, very relevant for traders. And I believe it's a very, very crucial area for us who are trading the financial markets. Most importantly, because most of what moves the financial markets, every single asset within the financial markets is moved by the institutionals. It's moved by the large entities that control volumes, that control influence of every single particular asset. So as we dive into this, it's very, very crucial to understand that essentially every single movement we see is not a mere movement. It has an influence. As you know, the CFDs, as we know them, are essentially products that we trade that derive their underlying, that derive their value from underlying assets. And all these assets vary. It could be stocks, it could be indices, it could be cryptocurrencies, it could be, of course, the Forex pairs, every single thing that we trade derives its value from something. That's essential to know. Yeah, so without wasting more time, let's just dive into the presentation. Yeah, so here what we have is essentially just an overview of the financial markets as we know it. And for those of course that trade with FXPesa, you are aware that majority of the assets that we have available on the platform Forex, we have stocks, we have the stock indices, we have the ETFs, those are the exchange traded funds. We have all these different assets, and they all derive their value from these different entities. Yeah, so what we have before us today are essentially the big players as we know them, and all these different players move the markets in one way or the other. So to start it off with, we're looking at the large stock exchanges. So now, guys, just to understand this better, some of these entities push the stock market. So they push the stocks, they push the stock indices, and they influence movements within these different entities, or rather within these different assets. Then the commercial and investment banks, because of the size of transactions that they handle, and of course we know for banks to be able to settle whatever clients they have, whether it's retail clients or institutional clients, they usually have transactions within themselves, just like you've heard about the overnight repo. So things like this. So sometimes some of the movements you see just so that the banks are able to make their settlements on time, so they exchange money and they gain an interest over the time that they exchange these funds. And it's because of that then we see some movements that we keep seeing on these different assets that we trade. So for the large stock exchanges, we know the NASDAQ. For those of you that trade US tech, or maybe the UT100 roll that's on our platform, you've come across the NASDAQ, so it's not something new to you. Then of course you also have the New York Stock Exchange, the Frankfurt Stock Exchange, and of course for those of you that trade Forex, it's very essential that you know what's happening with these big banks. So usually these banks will release outlooks, and those outlooks will indicate essentially what they are doing with certain pairs, or with certain currencies, and they will usually release targets for prices of all these different pairs or currencies, and that usually, of course, then informs us as traders to then know how to position ourselves, and also to be able to identify some of these movements. Yeah, so additionally, for those that trade stocks, you're also aware of the hedge funds. So for the hedge funds, we have Bridgewater Associates, which is the largest hedge fund. This hedge fund is owned by a gentleman called Ray Dalio, started by a gentleman called Ray Dalio. Then, of course, you also have the BlackRock and then Vanguard. So all these different hedge funds, of course, influence the stock indices as well as the stock market. Additionally, we also have the different types of financial markets and the different assets that are influenced, by these players. So stock markets, we focus on the hedge funds and the large stock exchanges. And then for the bond markets, we focus essentially on the commercial investment banks, because these banks, especially the investment banks, they raise money through bonds. So when they do that, usually it will, especially if the transactions are big, they usually, Fred, you're most welcome. They usually will influence the movement. Yeah. So all these different logos, as you see there, these are the top players as we know them for the Forex market. We have Citibank, we had MUFG, which is in Japan. We have JP Morgan Chase, Deutsche Bank, all these different entities influence what we see in the Forex market. Yeah, so for the NASDAQ, block trades are not something new. I'm sure most of you have come across block trades. For those that were at the beginning, or if you are able to come across cryptocurrency trading, you know that most of what was happening in the cryptocurrency market, Kennedy, you're most welcome. Most of what was happening in the cryptocurrency market at the times when we saw those big volatile movements or certain movements that could not be understood, it was because of the block trades. The block trades are the sizes of trades where you find they are quite huge, and they usually will cause substantial movement, in the markets. So block trades refer to a significant number of shares or a substantial amount of a particular security. These trades typically involve institutional investors, such as mutual funds, hedge funds, or investment funds, other than retail investors. So it's important to know, as we dive into order blocks, that the blocks we see are actually the types of orders that we keep seeing are actually as a result, of these block trades, especially if you're trading the NASDAQ and all these different stock indices. If you're trading Forex, what we see with impulsive movements in the market is as a result of settlements from these different banks that control these movements. Yeah. So what are order blocks? Order blocks are essentially areas of buying or selling activity that has taken place, indicating a concentration of orders. So orders usually will be piled up by banks at a particular point because they need to make a particular settlement, or because maybe if it's for the stock market, if futures are expiring at a particular date, they will usually pile up buys or sell orders so that they get a particular asset to actually expire at a particular time. So usually when you find, for instance, I don't know whether you guys have been able to come across some movements in the market whereby you find that price, has moved by so much. It usually happens, especially during when you had the Russia-Ukraine crisis, or even towards the end of the month. When you see towards the end of the month, you usually find that there will be some kinds of impulsive moments you find, maybe like on the indices or even on some of the major currencies. And this is essentially because of the concentration of orders at these particular points. Yeah. So when trading CFDs, order blocks can help traders identify key levels of support and resistance, providing insights into potential market reversals or continuation of trends. So order blocks are seen as areas where large market participants, such as institutional traders or banks, have placed their orders, resulting into an accumulation of buy or sell orders. So we understand this this way. When buy orders accumulate at a particular point, it will usually cause what we call as impulsive movements in the market. When sell orders accumulate at a particular point, we usually get an impulsive movement in the market. So impulsive a concentration of sell orders will cause an impulsive move to the downside, and a concentration of buy orders will cause an impulsive move to the upside. This is the better way to understand this. So order blocks can be identified by observing price patterns such as strong rejections or consolidations that suggest a shift in supply and demand dynamics. So supply and demand, of course, as you know, is not a new term for the financial markets. We know for those of you that have been involved in the stock market, you know that usually what happens is when a company is listed on a stock exchange, and it's supplying shares, it's giving the public shares. It could be giving retail investors such as yourself and myself, or it could be giving large companies, or large entities. For instance, here in Uganda, we have the National Social Security Fund, so the National Social Security Fund is usually on the all brands. Okay, I'll slow down. Yeah, the National Social Security Fund is usually on the demand side, okay, because it supplies, it provides the funds for the shares. So every single financial asset, we understand it as the supply side. So if it is stocks, if it is maybe currencies, and those currencies are going to be bought, okay, we call it supply. And when demand is from the buy side, when stocks are going to be bought, when bonds are going to be purchased, for a particular period of time, that is usually the buy side. That's the best way to understand it. Okay. Yeah, Brian, I'm saying I'm busy writing too. Okay, yeah. So just try and take notes as I go through. Of course, I have to manage time, so you might understand. Okay, so what are the different types of order blocks? So we have many types of order blocks. One of them, of course, we have the bullish order block, which is a price level or zone where buying pressure was significant, leading to an upward move or support in the market. And it represents an area where buyers have overwhelmed sellers, resulting into a shift in sentiment and a potential support level. Then, of course, then we have the bearish order block. The bearish order block is a price level or zone where selling pressure was dominant, causing a significant downward move or resistance in the market. Okay. Yeah, actually, yes, Fred, I'm seeing you've actually written something that's really good. Yeah, so Brands, what you could do, because of time, you might or might not be able to write everything, but you can actually download the video because it's actually recorded. So you can download and watch it in your free time because there's going to be quite a bit that we have to cover. So because of time, as you might understand, I might not be able to to go at your pace. I hope you understand. Okay, so we also have these other different types of order blocks. I will be going to the charts to show you guys right after I'm through, taking you guys through these different types of order blocks. Yeah. Oh, okay. Awesome. All right. So we have the price impulse order block. So essentially what this is, essentially, this is represented as the first week candlestick, that forms before a significant downward movement or retracement. Okay, so let's just have a look at what that looks like. Okay, see right here. Okay, yeah, you guys should be able to see that in a minute. Okay, awesome. I think you guys can see that. Hopefully it's clear enough. Okay, so this is essentially a summary of the order block. So we're going to look at different ones. We're going to look at different types so that you can get at least a wholesome, indication of what this thing actually looks like. Okay. So essentially, the buy-side liquidity or liquidity pool. So when we call buy-side liquidity, we usually mean where the institutions asks are sitting or where their buy orders are piled up. Okay, so usually you find that sometimes those orders won't be able to overwhelm the sellers, or they won't be able to overwhelm the sell orders. So usually when that happens, then of course we'll have rejection at that zone. Okay, and again, guys, we're talking about supply being equal to demand. So essentially, when the sellers are not able, well, rather when the buyers are not able to match up the seller's orders, so that they are able to branch up through that price, then of course price usually gets rejected downwards. So that's essentially what you have to understand. Then of course, when we're talking about certain key areas in the market or certain points where price action, breaks through, then we usually call that a break of structure. Just in a summarized way for us to understand that. So when you talk about buy side or sell side liquidity, we're talking about where the pools are piled up. So the liquidity pools are essentially where institutions have their orders. So if we're talking about currencies, for instance, like this is a currency pair, the big banks or maybe the high frequency traders, most of them, for instance, will have a certain block trade on the dollar card, or maybe we'll have a certain block trade on the United States dollar, and that overwhelms the sellers. So when that usually happens intraday, okay, when we have certain areas where price, for instance, has impulsive moves downwards, especially impulsive moves, then we know that there is appearing either bearish order block or bullish order block, just for summary's case. Okay, I hope that's clear for you guys. And what we are saying here is bids. So bids in the market is usually the sell orders. So where bids are piled up, then we know that's where the sell side liquidity is concentrated. But whenever the sell side liquidity is not strong enough, or if the sellers are not able to overwhelm the buyers with orders, then of course we know that the sell side liquidity is not enough, and price will keep consolidating until there's going to be a break of structure to one end or the other. So that's usually what happens with orders. So just for us to go back to the presentation, okay. So here we are seeing so now we have the week best order block. So for the week best order block, this is where the week is considered as an order block. It, however, needs to be greater than half the size of the previous candle. So I'm sure most of you are aware of wicks. So wicks are essentially lines, they are lines that we see attached to candles. So just like the wax candle that you have, that part where I usually light the candle when you're going to, when you want to light the candle up, So that extended part is essentially a wick. Even for those of you that are not into trading, that's the easiest way for you to understand what a wick is. So we know, especially since candlesticks are now used a lot by traders, okay? Essentially what happens is we try to use wicks a lot in our trading, and this is because wicks usually inform a lot, okay? So usually the way candlesticks appear with extended wicks or with less extended wicks, it usually informs something, okay? Okay, so when you check this example that's before you, we are focusing essentially on how wicks appear. So for the wicks, we need, in this case, we're looking at a bearish scenario. Okay, so bearish scenario means how does the order block appear? If maybe we are going to, have a potential for a sell. So when we talk about the wick being greater than 50% of the previous candlestick, we're talking about the size we're talking about the size of the candlestick. So if you look at this particular candlestick right here, where my cursor is, we're talking about this particular one right here, okay? Where we have this particular, wick having an extended kind of formation right here, okay? So where this particular wick right here, the one that forms after the previous candlestick, is greater than 50%. So by just seeing the wick here, it's already greater than the previous wick. So when we have the wick extended by this much, it indicates to you that there's a particular order block right there, okay, that is pressing price down. And usually what happens is that you will have an impulsive move that is extended, till a point where structure is broken, and then of course where you have the sell side liquidity pool sitting around. So whenever we have a break of structure, okay, so I'm going to try to be a little bit, I know time is not on our side, so I'll move a little bit. I want to be a little bit considerate. I'm seeing your comment there, Mokua. I'll try to be a little bit considerate for you. I'm just trying to manage the time, since of course, this is a quite sizable topic. Yeah. So essentially what we mean here is when we have the impulsive move right here, okay, and we have the bottom of the body, okay, the close of the candlestick. So of course, anyway, this was the low of the candlestick, slightly above the low of the candlestick. When we have the break below the low of the candlestick, rather slightly above the low of the candlestick, we know it's a break of structure. So at these particular points right here, where you have price not getting extended lower than, that's where you have the sell side liquidity pool. So at those points is where, when we have a retest of these levels, we know that because the sell side liquidity pool is right at this point, it's a potential that price may continue downwards. Okay, that's how you understand these liquidity pools. And again here, of course, this is the USD, the Euro USD on the 4-hour. So what essentially happened here is we had a break of this buy side liquidity pool. So whenever we have price action revisiting liquidity pools, then we know that the move will be impulsive. So that is how you understand these order blocks quite well. So like you see here, the liquidity pool for the buy side was seated right here. And it was because of that point that then we had a break above there. That is for the example of the week-based order block. So now we're going to cross over to look at the breakup block, rather the engulfed block. That's the other one that we're going to look at. So let's just wait to just have a look at the engulfed order block. So the engulfed based order block derives its name from the engulfed candlesticks, as well as there are different types of candlesticks. Some are bearish candlesticks, some are bullish candlesticks, and all these candlesticks inform something. So of course, engulfing, for those that are with us for the first time, then engulfing we're talking about is where we have one candlestick, becoming, appearing much larger in momentum than a previous candlestick. That is what engulfing means. So this is formed when the last bullish candle is completely engulfed by a bearish candle in a bullish scenario. And the vice versa is true. So the vice versa is when the last bearish candle is completely engulfed by a bullish candle. Then there we know that that of course is a bearish engulfing or a bullish engulfing. So let's just have a look at that, the engulfed based candlestick for us to see what it essentially looks like. Okay, so this is a bearish engulfed order block, and we're looking at the bearish scenario. So now, when you want to identify how a bearish engulfed order block appears, first thing you need to look at is the type of candlestick that you have appearing after that candlestick. So usually what happens is that before the engulfing takes place, we have this particular area of interest where we are having price, the buy side not showing itself strong enough, and where we are followed by this impulsive move to the downside. So the impulsive move to the downside is essentially because the buy side liquidity pool that was sitting here. Now, again, guys, here we're talking about a stock index. So for the stock index, the asks or the buy orders for every single stock that is under the Dow, okay, did not have enough buy orders. There wasn't enough buy liquidity for us to have a break of this particular point. So it's because of that then we have this engulfing right here. So this engulfing is an indication, this engulfing right here is an indication that we are having price action potentially moving down. And again, it also indicates to you that the supply is overwhelming the demand at this point. So whenever supply overwhelms demand, then it's usually signified by this kind of engulfing we're having here. And again, as you can see, the sell side pressed and pressed and pressed and pressed and pressed and pressed all the way to this liquidity pool that we had here. Yes, so Brian, you're asking, Kiza, why would a certain price keep being retested? Okay, so a certain price might be retested because of particular prices that are being filled in by particular players. So for instance, you'll have like a stock like Apple, where a lot of institutions or hedge funds are filling in prices for a particular stock, okay, at a particular zone. So for instance, now like if you see on the counter, like for Apple, what happens is that you have that institutions have set in buy orders at maybe 190 or 188, okay? So what happens is that if the buy orders keep accumulating at a particular point, okay, or if hedge funds keep piling up on particular stocks at a particular price point, then you will keep having repetitive block trades at these particular areas. That is usually what happens, Brian's, with prices being retested. The same is also true. Thank you, Herman. The same is also true for the sales. If the hedge funds keep piling up short positions or keep providing liquidity for short positions at a particular price, okay, it will then indicate usually that's the price that will keep being retested when you look at our charts, because the block trades keep appearing at a particular point. So that is essentially what happens. Yeah. So as you can see, this was actually on Friday, guys, this was actually on Friday. You can imagine it was just on Friday. So if you check actually on the volumes of those particular stocks, you will find that price was kept pressing downwards, because of the size of orders, of block trades that were stopping demand. So whenever supply overwhelms demand, then you will have that impulsive move. We're talking about impulsive moves here, impulsive moves, okay? So again, if we have a retest of sell side liquidity pools, it usually indicates that price will have, a move downwards. Whenever sell side liquidity pools are retested, or areas where sell side liquidity pools or buy side liquidity pools are, then it's always followed by, impulsive move downwards. Yeah. So that's essentially what this means. Okay. Okay, so we're going to then look at breakup blocks. Breakup blocks are very interesting, okay? And essentially what breakup blocks mean. Breakup blocks, these are formed when price action breaks structure through previous liquidity zones with an impulsive move. So now for those of you that trade Forex, essentially what you're focusing on is particular demand or supply zones, and these particular points of interest or supply zones is essentially where maybe the banks are having a lot of their settlements targeted for. Okay, so for instance, maybe when Barclays has come into an agreement to, for instance, maybe sell euros to maybe HSBC at a particular price, there will be repetitive breaking of these particular areas, which of course we'll call breakup blocks, because the banks, maybe one particular bank has maybe a settlement that it needs to make, and it keeps making it at this particular price. Okay, so that's why you'll find have certain levels appearing. So that of course is intraday. For those of you that are trading, if you're trading on a long term, you'll be able to identify, some of these price patterns. Yeah, something else I also need to share with you, especially for those that focus on trading. For those of you that focus on trading, if you focus on trading, gold, there's something interesting that I need to share with you, which is the COT report. I don't know whether you know about the COT report, okay? But I need to share that with you because COT will indicate to you essentially where these particular areas of consideration are, and also essentially what also influences these movements we keep seeing. Okay, sometimes markets look to be manipulated, i.e. forced to move in an opposite direction, looking at all time frames. Is it true, sir? Yes. So essentially what of course we know as manipulation is because in a futures market, when large market players want to have, once they want to have price, getting met at a particular point, or for their futures contracts to expire and profit, they'll normally start, usually building trades for that movement to happen. The other thing, of course, is usually towards the beginning of the month or towards the end of the month, you'll find that usually price will be moving to particular zones. And that is essentially because of what we're talking about regarding expiries. Yeah. So Brian, you're asking, Mr. Kiza, does it literally mean retests to happen at points of break of structure? Yes. So usually it's not cast in stone that retests happen at particular points of break of structure. But what we know, of course, in order blocks or smart money concepts is that usually a break of structure is when a particular area which was where sell side liquidity pools were seated, but of course demand overwhelmed the supply. Then if we have those points being broken, then usually that's what we call a break of structure. Retests usually, of course, will happen at those particular points, but the retests usually may not happen at those points. They may happen at new points, okay? And usually what happens is that usually what causes that to happen is because of particular block trades that are sitting there. Yeah, so Apollo, you're asking what is COT? So COT is a commitment of traders. So usually these CFTC non-speculative positions are usually shared with traders for us to know what is usually causing a pileup of particular, rather what are the current positions for particular players. So you have different, so you can have gold. There's also currencies, stock indices, all these usually there will always be a particular a particular entity that usually will push price. Okay. Yeah. So Makua, before you end this, I have non-related questions. Okay, I'll get to you. Yeah. So for gold, we focus on the producer, stroke merchant, stroke processor, stroke user. And you're seeing here that their positions keep being modified every week. We also have the short positions and the long positions. So these, of course, really will indicate to you. They will indicate to you essentially what is happening with particular pairs. So you can have gold. Then if you check, of course, for currencies, same thing, of course, like for the Australian dollar, you'll be able to see where particular orders are being seated. So of course, even for Australian dollar, we are seeing the dealer stroke intermediary. So banks usually sit under here. Okay. Then asset management, asset manager stroke institutional. So here, in our case, we might have some of the different asset management firms. Then we might also have leveraged funds. Leveraged funds is where you sit. For those of you that are trading CFDs, you sit under the leveraged funds. So you'll be able to identify certain areas. So of course, this data is good because it helps you to track what is happening on that particular asset that you're trading. So Apollo, you're asking, are institutional traders buy retail traders to provide liquidity? Okay. All right. So the link for this, let me just get that. See, that's the link right there. Okay. It's Trading Star. Go to tradingstar.com. You'll be able to get all you need right there. Okay. So as you wind up, I just needed to show you something on the breakup block. Okay. So let me just show you that quickly. Just a moment. Okay, Apollo, I hope you're okay now. I've been able to share the link with you there. Okay. So guys, as you wind up, I just need to show you a breakup block here. Okay. So breakup block, we are saying this is formed when price action break structure. Okay. Let me see. Okay. So this is formed when price action breaks structure through previous key liquidity zones with an impulsive move. Okay. So in this case, the impulsive move we had today, this is a really good example. This is gold on the H1. Okay. So you can see the kind of movement we had there. Okay. So here we had a break of structure right at this point. Sorry, I hadn't labeled it yet. No. Then of course, right after that, okay, we had this impulsive move right here. I think you guys can see this right here. This was a really, really big impulsive move. And this, of course, was likely because of a pile up of demand, or a pile up of asks or buy orders that caused this move, right? Same thing also that we had was right here, okay? You know, we had a bit of a break somewhere here. Okay, I think you can see this move right here. Okay, so again, unless we need to really see how serious we need to see how serious the buy side liquidity is. So unless it breaks through here, okay, then of course we are unlikely, you know, to have you know, an indication of how serious that the demand is for gold. Yeah. So Apollo, you're asking, yes, but not understanding what to make out of this COT report. What position to take, either longs or shorts? So the purpose of the COT report, and of course this data is usually on every economic calendar, it usually indicates to you what the bias is in the market. Okay. That is why you need to be able to monitor the COT report. The COT report is essentially for determining the bias in the market. So usually there will be a bearish bias or a bullish bias. So when you gauge that data, then you'll be able to determine what the bias is in the market. That's the purpose of the COT report. Okay. So so just to wind it up, what we are saying today is order blocks are essential because you'll be able to determine usually you know, how price is moving and how price can be followed up, and it will also be able to indicate to you particular areas that you need to be able to take consideration in whenever you're trading. So this strategy for order blocks is really, really nice because you're able to monitor so much with it. Okay. And there is the big part with understanding this is that you will be able to utilize it quite well for your trading, but you'll also be able to use it in your confluence with whatever else you're trading. Yeah. So Mokua, you had a question for me. In case maybe you know, I hope you're there. You could ask a question. Yeah, and I hope you all had a great time. on the webinar. Please, we have quite a lot of valuable information for you guys through these webinars. Please invite your friends, invite your fellow traders to be able to attend these webinars. And I hope you all will be able to benefit the next time you come for this class. Yeah, so Apollo, you're saying thank you, but please go back to the security report. Let us understand what the bias is on gold. Okay, that's a nice one, Apollo. That's a nice one. Okay, awesome. Okay, let's see. So here we go, Apollo. Here we go. Here we go. Okay, so for gold, the bias essentially here is a bit of a mixed one. Okay, but what we are seeing is when you look at the long or short, okay, right here, you can see that the dealers, okay, and the other reportables are essentially piling up on their long positions. So much as the asset manager leveraged money, and non-reportables have a bit of a mix in what they're holding. You can essentially be able to tell that based on the short positions, for instance, like the asset managers that usually have a bigger demand or a bigger influence on the market, you see that the short positions are overwhelming the long positions. When you come to the leveraged funds, of course, you'll be able to identify here that the short positions, of course, then are slightly lower than the long positions. So what usually happens with this CFT data is when you add up these long or short positions, you'll be able to determine what the bias is, okay? And of course, much as you're able to determine the bias, make sure you also apply all your other different trading tools when you're trying to look for trades. This, of course, is to be able to show you essentially what is happening. The other thing I also need to mention regarding gold for Apollo and for those of you that trade gold is gold is always also usually influenced by the central banks. Okay, so when central banks are having big gold purchases, it will usually press price and call and cause a squeeze, in movement, of these particular assets. So you also have to look out for that. Why names include roll, i.e. US roll instead of US 30? So US 30 roll, Cyrus, is because it's a rolling CFD, So there are different types of CFDs you can trade. If you're trading the US 30, you can trade it as a rolling CFD or as a futures. So if you're trading it as a rolling CFD, it means that you can hold your position from today into the next day into the other day as a rolling CFD, and you will only incur what is called the overnight financing costs in form of the swap. That's why it's called a roll. So it's a rolling CFD. That's what it means. Yeah. So guys, with that, I think I need to wind up. Okua had a question, but don't mind. You can always shoot me, a message on Twitter, and I'll be happy to respond to you on my Twitter. That's Nobert K Barije. With that, guys, I would like to end the webinar, and I hope you all had an incredible time listening and hearing about order blocks. There will be several other webinars later where you'll be able to get to understand more about this information, and you'll be able to utilize it in your trading. So guys, I wish you all a very lovely evening, and I remain Nobert Kiza. I wish you all very well. Thank you very much.